Hi everyone, this is Ted Bauman, editor of the Bauman Letter and of Bauman Daily, and also Profit Switch. If you click on the link up here or in the one in the description below, we have a link to the promotion for my Endless Income package, which is basically access to the Bauman Letter, but it tells why I like to focus on income producing assets. You'll also get a copy of the book, which is behind me, Endless Income, which includes other ways to generate income, including things like real estate investment trust, master limited partnerships, and so on, closed-end funds, all the different kinds of ways that you can generate solid income over time. Today I want to talk about the relationship between the Federal Reserve and the stock market and why it has become really unsustainable. It's a Mexican standoff. Now, if you're worried about the Fed, a lot of people talk about inflation. Well, inflation is the least of your problems. Typically, people worry about the Fed because they think that the Fed is pumping money into the economy and that will cause prices to go up. But in reality, what's happened over the last couple of decades, really, more back 15 years, is that the Fed has pumped money into the banking system. Financial systems, or rather financial conditions, have been very loose, and that has had a dramatic impact on asset prices, particularly equities. Now, that's got to the point where the Fed may have tied its hands. It can't actually reverse this policy. I want to talk about today why that's the case and what that could mean for you. Well, last week we saw the Federal Open Market Committee meeting, which is where the Fed decides on its forward-looking policy. And the reaction to that meeting was quite profound. The market went ballistic over the idea that the Fed might raise interest rates in 2023. As somebody pointed out, when somebody who has a child today, when that child would be about 2. So they're worried far ahead of time. But it shows how sensitive the market is to the Fed's forward intentions. Let's look at why that's the case. Well, what does the Fed do first? I mean, let's consider what the Fed's role is supposed to be. It's supposed to be the lender of last resort. In other words, if an individual bank or the banking system as a whole gets into trouble, the Fed steps in, it pumps liquidity into the system so that banks have enough money to meet their obligations, to make loans, and so on, without the whole economy seizing up. It's also supposed to try to keep unemployment as low as possible, and that's the two mandates. But the Fed has developed over the last decade or so a third mandate, which a lot of people now take for granted, and that is to keep financial systems, or rather conditions, as loose as possible, to keep as much money going into the economy as possible. Well, what are the impacts of that? Well, one of the things to do is to start with a picture of the stock market historically. Here is the Case-Shiller price-earnings ratio going back to the late 1800s. It's peaked 3 times. One was just before the Great Depression. One was just before the dot-com bust of 2000, and one is right now. In fact, right now, the Case-Shiller PE ratio is at the highest it has ever been, other than the dot-com burst. But if you look at the speed of the drop of those of the PE ratios after something bursts, you can see why there's cause to worry. In other words, if it were to happen like it happened in Black Tuesday or at the dot-com bust, you can see why, if you were a holder of stocks, you should be worried. And here's why. Stocks go up for 2 reasons. One is if earnings increase. If you have a steady PE ratio, for all of the things being equal, if earnings go up, the price goes up. If you increase the price to earnings multiple, the price of the stock will go up while earnings stay the same. When financial conditions are loose, people are generally willing to pay more and more money for price earnings ratios. In other words, they're willing to expand those multiples. And one of the main drivers is low interest rates. Now let's look at another aspect of the stock market. This one is the Buffett indicator. This is the total market capitalization of the US stock market vis-a-vis the GDP. Now, the historical trend line, fairly valued, is supposed to be around parity. When that indicator is above the parity line, it means that the stock market is historically overvalued relative to its long-term trend. Now, we can see that it's since 1950, it has had a couple of periods during the 60s and 70s when the government was spending a lot of money on the Vietnam War. It was high. Then it fell during the tight conditions during the 80s and early 90s. Then it rose dramatically during the internet bubble, the dot-com bubble, and today. Today it is at a ratio of 232% relative to GDP, which is the highest that it has ever been in our living memory. Now, why is this important? It's important because it shows you how far we had to fall. Basically, as Jimmy Cliff sang, the bigger they are, the harder they fall. It's the same with stock prices. I'm not predicting a crash. I'm just telling you what the stakes are. Now, let's look at one of the reasons why this has happened, why we have seen such a dramatic increase in both the Case-Shiller PE ratio and the Buffett indicator in the last decade. Here's a chart that shows total Federal Reserve assets held on a weekly basis. It kind of was, just dawdling along up until the great financial crisis, at which point the Fed then started buying mortgage-backed securities and treasury bills out of the market in order to pump money into the banking system to prevent banks from failing, and also to keep the economy ticking over. Things like overnight loans and basically the payday paper market, while firms trade money with each other, to meet their payrolls. All of that seized up. The Fed stepped in. That problem went away. Now, the Fed continued to gradually buy more assets until 2013, when it tried to taper, and then the bond and U.S. stock markets had a big tizzy, and then they had to restart it again because the market didn't like the fact that the Fed was trying to taper. So that was what was known as the taper tantrum. The Fed then stopped buying. It maintained its levels throughout the next couple of years until 2018. The Fed began to gradually pull back again. There was a bit of a taper tantrum at the end of 2018, but the market gradually accommodated itself to the fact that the Fed was just going to be selling these assets. It wasn't going to raise interest rates. That's the way things went until COVID. When COVID hit, all of a sudden the Fed added something like, $4 trillion worth of assets to its balance sheet. Now we're at the point where it has nearly $8 trillion worth of assets. Now remember, when the Fed buys things like treasury bonds and mortgage-backed securities out of the market, it has two effects. One is that it depresses the interest rates for those things, the yields on those bonds, which keeps interest rates low. The other thing it does is create artificial scarcity for them, which means that because the Fed is holding so many treasury bills and mortgage-backed securities, there aren't enough left on the market to satisfy everybody's demand for safe, steady income, fixed income assets. The result is that their prices go up and yields stay down. Now, what would happen if the Fed suddenly began to release those onto the market? Yields would skyrocket and interest rates would go up. Now, we'll talk about the implications of that in a minute. Now, here's a chart that overlays those two things. It's easy to see. The Fed balance sheet in blue, the S&P 500 in black. To me, that's a pretty tight track. When the Fed begins to pump more liquidity into the market goes up. That happened between 2008 and 2013. Then, when the Fed agreed to rise or to pull, you can see there's a little bit of a wobble there between 2011 and 2013. But then when the Fed begins to pump liquidity back in again, the market again develops its upward trend. Then as the market, or rather as the Fed tapers or maintains a steady rate of accumulation of these assets, the market again kind of tapers, 2015, 2016, 2017. Then the market picked up again after 2016. That, I think, is because of the Republican control of Washington. But then look what happens when the Fed increases its balance sheet to $8 trillion during the COVID crisis. The market follows it like a little puppy dog. Now, here's an example of what happens when the Federal Reserve tries to pull back on this stuff. Here's a chart that shows the big taper tantrum that happened at the end of 2018. It shows the S&P in black and the US 10-year real yield in red. What happened then was that Chairman Powell wanted to try to raise interest rates back to what he considered to be a normal rate. And so he announced his intention to do so, and he began to talk about tapering. But look what happened to the market. The S&P fell from somewhere around 2,900 down to a low of below 2,400, a huge drop. Then Powell pivoted. Here's a chart that shows Powell's pivot when he said, okay, all right, I give up. I'm not going to do this. The market then began to rise again over the next few weeks after he made that statement. The bottom line here is that the Fed has become a major player in terms of the direction of stock markets by providing this liquidity that is supposed to be an emergency facility, but which is now a permanent part of our financial system, particularly in the stock market. Now, here's another place where the Fed's activities show up, the housing market. The blue line is the S&P Case-Shiller 20 City Composite Home Index. And the track with federal mortgage-backed security holdings is profound. Now, MBSs are basically the Fed taking money from the banking system by buying the assembled mortgages that are put into these mortgage-backed securities. So essentially, the Fed is pumping money. It's buying mortgages. The Fed becomes the lender of last resort to mortgage owners rather than the banks, and that depresses interest rates. Now, when the Fed did this, when it first made a big run at this back in the great financial crisis, house prices skyrocketed. Then when the Fed backed off, house prices sort of stabilized. Then when it started to taper MBS, house prices fell. Then when it started buying back MBS again in the COVID crisis, look what happens to house prices. So the bottom line here is that the Fed is effectively propping up higher prices in both the equity markets, the stock market, and in the housing market. Now, we look at house prices and think, oh, it's because of lumber. The bottom line, folks, it's because money is cheap. And in the long run, that only benefits people who have enough money already to be able to participate in those asset markets. If you're poor, basically, you can't do that. You don't have the money to be able to do that. Now, what we've got here is a situation where whenever the Fed tries to reverse this policy, which was an emergency policy that it adopted after the great financial crisis, that it doubled down on during the COVID crisis, the market rebels like we saw last week. Now, I would say, as somebody else put it, the slave has become it's become a slave. The Fed has become a slave to the bubbles that it blows. I think that's a great quote. The Fed has become a slave to the bubbles it blows. It cannot change this policy, folks, without causing massive disruption to the financial system. Now, think about how many loans around the world, in all kinds of contexts, are backstopped by ownership of stocks or backstopped by ownership of real property. If the Fed began to taper, sell these things in order to try to push these assets back out into the private markets where they belong, interest rates would rise, and that would cause these bubbles to collapse. So fundamentally, yes, we have a nice high rising stock market right now, but a lot of it comes back to the Fed. So what would happen? What are the downsides of this? Number one, by continuing to prop up the economy in this way, even in conditions that are not really crisis conditions, the Fed is basically taking recessions that should have happened and would have happened. They're putting them in a safe, and someday that safe is going to have to be opened. We're going to have to basically catch up with all the recessionary conditions that we missed and avoided because the Fed backstopped everything else. So basically, eventually, if the Fed were to change this, we'd have a big deleveraging, and that would be a big recession. It might not last forever, but it would be a big, big drop, and it would cause asset prices across the board to drop. The second thing is that the Fed's policies have dramatically increased inequality because realistically, the only people who can enjoy these rising asset prices, thanks to the Fed's easy money policies, are people who already have money, people who already own homes, people who can buy stocks, and so on. The rest of the people, they get no benefit at all from this, and yet they're the ones who are also poised to be crushed if the economy were to go through a major recession, if the Fed tried to engineer a return to normalcy. The third thing is, of course, that equity valuations have risen dramatically because of this multiple expansion, which we're starting to see resume again after the last week's FOMC meeting. We're starting to see a rotation back into high multiple stocks. That's only sustainable if the Fed never changes. In other words, if the Fed starts talking about raising interest rates, if it starts to taper, if it starts to push some of these mortgage-backed securities and treasury bills back into the market, then their prices are going to go up. That's going to make these stocks less attractive. And people like you and me who own those stocks are going to lose value, which means we lose wealth. Now, if the Fed tried to conduct a controlled demolition of the current system, in other words, if it tried to say, look, we got to taper, we got to let interest rates rise, we got to do this, holders of equities would suffer severe short-term losses. I'm talking something like 60 to 80%. I'm not saying that it's going to be permanent, but there would be an adjustment phase that would really wipe out a lot of people. Now, if you held through that, I believe you'd come out okay, but it's still going to be painful. Here's 3 things you need to be prepared to do for yourself if that looks like it's going to happen. The first thing is make sure you know the risk-adjusted volatility of your stocks. Look at the historical volatility of the positions you hold. If they have high volatility, in other words, if they tend to deviate a lot from their trend line, then you need to be prepared to dump those stocks at least temporarily prior to any big Fed moves. Now, I think we'd have forewarning if the Fed did such a thing. I think there'd be lots of discussions in the news. And I think that's exactly what's happened this year. People thought that the Fed would withdraw the kind of support that's been giving because of inflation fears. And so they started selling off these high value stocks. That's what we've already seen. So that's an example of what we could see in the future. But if the Fed did it seriously, those stocks would plummet and you'd be better off getting ahead of that curve and getting out of them. So know the volatility, the volatility of your stocks. If they have high betas, if they have high deviations from their standard course, sell them before this thing happens and then reacquire them when the dust is cleared, or at the bottom, even better. The second thing is educate yourself about what you need to do to protect the value of your portfolio. Know about inverse ETFs, know about safe havens like the yen, like the Swiss franc, and other safe haven assets. Find out what kind of ETFs hold low volatility companies that are not going to fall by as much as, for example, happened in the great financial crisis. They're out there. Look for low volatility ETFs. Now, finally, the most important thing of all is even if the Fed does engineer a controlled demolition of the current system to try to get back to normal levels of interest and also normal levels of distribution of financial assets like the treasuries and MBS in the private financial sector as opposed to on its own balance sheet, when it does that, it's not going to be the end of the world. Eventually, the stock market will respond to a robust economy. And I believe that we're only halfway through the current big bull market that we have seen since around 2009, 2010. There may be a big dip, but that's going to be your opportunity to pile in, buy more of those stocks that dip, and get out on the other side with a lot more wealth than you would have had if you simply didn't anticipate it. Now, that's my message for today. I'm not saying when it's going to happen, but I do believe that this is the setup that everybody needs to know. We're living in a mousetrap economy, a mousetrap stock market. Hopefully, we will be able to see the mouse approaching the cheese and act beforehand, but only if you understand what's causing it and why it's so important to educate yourself with the steps you need to take to stay safe. This is Ted Bauman signing off. I'll talk to you again next week.